Hi, class. Today's lecture is about accounts receivable, an asset that shows up on the balance sheet, and it's a right to receive money from customers that we sell to on account. So almost all businesses sell to other businesses, especially in business-to-business world, on account. So they will deliver the product to the customer with an agreement that the customer will pay them. A lot of times it's 30 days, up to 60 or 90 days, but it's not a long-term deal. If you have a long-term deal like that, we're going to have a notes receivable, which is in the next lecture. So we're talking about accounts receivable here. It's kind of the grease that skids the businesses, helps them to operate. Companies buy stuff on account and have accounts payable, and they sell stuff on account and have accounts receivable. Now, why do companies trust other companies to pay them? You know, wouldn't you just say, hey, I will give you my product when you give me your cash, first, Well, in a lot of industries, that's just not going to work. If you were not willing to offer what we call offer credit on terms, then companies wouldn't do business with you. So the reason that we we sell stuff on account, knowing people will pay us later, is we're trying to increase ourselves. We're trying to get out there and have as high of a revenue as we can. And we do look at these customers before we ship their product. We're going to look, is this a good customer to ship product to? We would not knowingly ship product to someone that we didn't think was going to pay us back. So we do our own due diligence and research, but companies will sell things on account. So let's that's the business kind of behind this chapter. Let's look at the accounting. I'm going to share my screen and we're going to look at accounts receivable. And there you go, right up there, right off the bat. So I'm going to start with journal entries here. I think that's the best way to go. So you can see my face here. Probably better if you didn't see it, but let's do it the right way here so you can see what I'm talking about here. Let's move this over a little bit. And I'm new to this whole Zoom world, but I'm getting there. All right, guys, here you go. The first entry is going to be, and you've seen this before, we're going to record a debit to accounts receivable when we sell the product. And that's a debit, and then we're going to credit revenues. I'm not going to put amounts here. Let's just start to learn this. And I'm going to, I use like A/AR to stand for accounts receivable, so you'll have to get used to that. And here's revenues. And so companies in here, entry one, beginning balance, don't worry about that. We start with the beginning balance. Whenever we sell something, we collect, we record a debit to accounts receivable, and we credit to revenues. Now, I want to talk about this entry for a minute. And this is the entry we record. It's the most important entry in this chapter. And it's the entry that we record to recognize a revenue when we've sold something. But there's a lot of rules around the recognition of revenues. Why? It's about timing. And so you would think this would be easy, but the generally accepted accounting principles, I think it's a couple hundred pages of discussion because there's so much complexity in business that there's so many different kinds of transactions that you have to be almost cautious in how revenue gets recognized for those transactions. It's way beyond the scope of this course. You have to worry about those 200 pages, but let's just talk about it in a minute. What I want you to understand here, that it is about timing. Revenues cannot be recorded too early or too late. It is why do we care so much about revenues? It's the number one positive item on the income statement. Remember, the income statement tells us how much money, how much earnings the company is making. How is the company doing? Is it a profitable company? And how do we know if a company's profitable or not? revenues minus expenses. And so that accounting period, we want to make sure we have all the revenues for that accounting period recorded accurately. And we don't want to have any revenues that should be in a different accounting period included in this accounting period. Second point, we're going to match up all the expenses related to those revenues. So I'm going to give you just a high-level summary about timing. How do we recognize this timing? And the rules have a kind of a step-by-step analysis that you have to do. Number one, you've got to identify the contract that you have with the customer. And this is going to be an oral or a written contract. And I'll give you an example of one that you have, that's an unwritten contract, but you'll understand it's just kind of common sense here. So step one is, what is the relationship? What's the contractual relationship between the company and its customer? Step two, what are the performance obligations that are identified in this contract? So what does a company have to do in this contract? What do they have to do to perform for the customers? Is it providing them a product? Is it providing them a service? What are the actual exact performance obligations required by the company? Step three is, what is the price? A predetermined price that the customer and the company have agreed to, that will be the exchange price for each of these performance obligations. There could be more than one performance obligations. That gets into some of the complexity you're not going to have to worry about. And step four, you allocate the price to each of the performance obligations. Again, that step four is beyond the scope of this course. But here, step five matters. You record revenues when you have completed your performance obligation as a company. Not when cash is received, not when you have a contract. No, only when the performance obligation is completed. Let's think about one of my favorite companies in the world that gets me going in the morning, Starbucks. You walk into Starbucks, and guess what? You're going to have a very quick and small contract with Starbucks, and you are going to order. Let's just make it a simple cup of coffee. I just get the basic venti coffee. That's probably about $2 these days. Pretty high price, I guess. But I can look on the board and I can see coffee, $2. So the price is identified there. What's the performance obligation for Starbucks? They got to give me that coffee. And by the way, I want it to be fresh. It better be hot, And so there's a contract there. I can look at the board, know the price. I walk up to the register, order that cup of coffee, and then and sit there and wait. Go back into the line and sit there and wait around with the other Starbucks customers waiting to get my coffee. So Starbucks and I have a contract. I have given them $2, and they are going to give me a cup of coffee. And Starbucks will recognize revenue when they fulfilled that performance obligation, which means giving me that physical cup of coffee. Hopefully that kind of makes sense here. So there's a lot of these many kind of arrangements like that are small contracts, kind of implied contracts, if you will, that happen every day in our lives. And the delivery of that coffee is when Starbucks will recognize revenues. And so the timing is important here. Now, by the way, this is not part of this particular subject, but I cannot help myself. If you're selling a product, you're also going to record a cost of goods sold, which we'll get into in a later chapter when we talk about inventory. So Starbucks, let's just use Starbucks example. That coffee inventory now is down. It's declined because it's in my cup of coffee, and they're going to record an expense. So we'll have a revenue and a cost of goods sold expense for every transaction that involves a product. Again, not one of the key entries here. Now, third entry, and this is a nuance that you haven't seen before. When we sell stuff on account, guess what? This is the sad reality. everybody's not going to pay us back. You know, legally, we can go after them and do everything in our power to make them pay for this, but they are not going to. Maybe they're out of business. They don't have the cash. They don't have the money. They cannot pay us even if they wanted to. So businesses take this risk, and they're willing to take this risk in order to grow revenues. In fact, on average, really, really good companies, I think, will not collect about 2% of their revenues on average. And in fact, if a company was collecting 100% of all their revenues, maybe they're not taking sufficient risk, and they need to expand out and try to take on some more risky customers. Now, having said all this, no company is ever going to ship a product to a company that they do not believe they're going to pay them back. So when we ship this product out, we know maybe, let's say on average, 2% will not pay us back. But at this point, we do not know which customer is going to not pay us. And we know on average, based on historical experience, maybe 97, 98, whatever, every company's different. We know on average how much of this that we will receive back. And so this risk is an expense for the company. And when do we recognize this expense? Remember, we want to recognize all the expenses. We want to match up with the revenues. So when we sold these revenues here, we know some percent of that was not going to be collected. And so immediately we will record the same timing as recording a revenue. We're going to record an uncollectible expense that will go to the income statement. And so expenses have debits, and so this is in item number 3 here. And they're going to have an uncollectible expense. Now, what do we credit here? Because we have a debit, we also have to have a credit. Well, in the accounting rules and in accounting practice, we don't want to muck up our receivables, right? Because we've got this accounts receivable balance. And by the way, the journal ledger will keep the total balance of accounts receivable, but we will have subsidiary ledgers that tell us the names of all the companies that owe us money and how much they owe us, because we're tracking that carefully. We might be calling them when they're past due and trying to collect that money. We're very judicious around that accounts receivable and the subsidiary ledger. So we don't want to mess that up. So we're going to create another account, and it's going to be called the allowance for, I don't have enough room here, allowance for uncollectible accounts, and it's going to have a credit balance. And by the way, this is a balance sheet item. And we have a special name. So our debit is to uncollectible expense, and our credit is to the allowance for uncollectible accounts. Now, this is called a contra asset account. Why do we call it a contra asset? About number one, it's got a contradictory balance. It's got a credit balance. Remember that the normal balance for assets are debits, but this has got a credit balance, and it represents at any point in time how much we think we will not collect from our accounts receivable. And so here's a new term for you also. Net realizable value equals accounts receivable minus the allowance account. I use that A/C for account sometimes. That's a kind of a standard kind of thing for accounting. So net realizable value means, hey, of that receivables we have on our books, we're not going to collect all of it. The net realizable amount of that is going to be, I can add together the debit from accounts receivable minus the credit in the allowance account. We'll see other contra asset accounts through the course. A contra asset account always has the opposite balance and always is directly tied to an asset account. So that's there. Okay, and the last entry that you've got to know for this chapter, this section, is what happens when these accounts, we find out which accounts are not going to pay us. In other words, when we ship the product to the customer and record revenue, we fully expect them all to pay us. We're going to call them. We're going to like be nagging them if they're not paying us. But eventually, some of these accounts will go bad and they will not pay us. If you want to think about the process for a minute, let's say it was due in 60 days, and it gets to the 65th day. We're calling the customer saying, "Hey, what's going on? You guys are late." And they'll say, "Don't worry, check's in the mail." The famous check is in the mail. And we get to day 75, day 80. We say, "Oh, you know what? We didn't get that check yet. What's going on?" And they say, "Oh, yeah. Well, we got some system problems." Sometimes they'll just make some excuses, and you get to 80 or 90 days out, you think, we don't believe them anymore. They say, "Hey, guys, what's going on?" Now, one of the first things you will do is you will stop shipping them any more products. If they're not paying you, you're not going to ship them any more products. And they may beg you, "Hey, we got to stay in business. Please help us. Ship us some of your products because we want to resell them." And we'll say, "Yes, we'd be just love to ship you more products. However, you haven't paid for the products we shipped you before. In fact, you're past due. You're late. So once you pay us for the old products, we'll ship you new products." And so this is just ongoing business operations. And so in the credit and collections department, that's what they do. They are managing the risk that's related to accounts receivable. It's a pretty good job. A lot of finance majors will probably get into a job like that. Now, ultimately, we will provide these to a collection agency. Now, we're pretty slow to give it to a collection agency because they receive 50% of whatever they collect. And so that's 50% that we don't get. So we're kind of slow to give it to a collection agency. But when we've tried everything we could, we'll turn it over to collection agency and attorneys. And they'll go after these companies because we have a legal right to that money, and they will try to get it. Okay, another 3, 4, 5, 6 months passes, and we find out we're not receiving any of this money. And so we get a call from the collection agency. "Hey, this company's never going to pay you. It's over. Did everything I could. Just let you know, you can write it off." That's what we say. We're going to write it off, meaning we're going to not chase this customer anymore. This is a debt account, and we're never going to receive this money. Well, keep in mind, back to the journal entries here, we estimated, hey, in this third journal entry here, some of this was going to be uncollectible. And we didn't know which accounts. Now we know about a particular account. So here's the journal entry we do. We are going to reduce the uncollectible, we're going to reduce the allowance, and we're going to reduce the AR for the value of that particular receivable. So we're going to how do we reduce an allowance? It's a normal credit balance. We're going to debit the allowance for uncollectible accounts. And we're going to reduce receivables by exactly the same amount. So in entry 4, we reduce AR and we reduce the allowance. And so basically, here you go. That's about, those are the journal entries you're going to need to know for this chapter. There would be one more journal entry, I guess, when we receive cash, debit cash, and we credit AR. And so that would be another entry here. Just put it up there somewhere. When customers pay us in cash, they no longer owe that money. That's another reduction in AR. So the only kind of things that can happen in accounts receivable during the year, we could sell stuff on credit, we could collect cash, we can write some stuff off. In the allowance account, the other balance sheet account, we can set up the allowance whenever we record an expense. What's an expense? It's related to the revenues. And so it's tied directly in that expense. And we can write up accounts. There's only two things that can happen to allowance account. So basically, this little page right here is everything you need to know about accounts receivable. Obviously, you need to read the textbook, please, as well. Do not do that. So here, I'm going to work a couple of problems with you. Let's see where I've got these right over here. And so, if you think you're ready to go, I'm going to work this here in a minute. You could first just try to work it yourself, pause the video and work it yourself. And then I'm going to work this problem myself. All right. Hopefully you did try to work it yourself and you've restarted the video now. So accounts receivable has a balance of 50,000 and we don't have any activity. So it's just the ending balance is 50. The beginning of the year balance in the allowance was 5,000. So that's a credit balance of 5. And the percent of sales method calculates an expense for 5,000. Now, the percent of sales method, all we do is we take the revenues during the year and we multiply it times our estimated percent that has been our historical experience. So in other words, if we had $100,000 of revenues, credit revenues during the year, and we think on historical experience about 2% of those go bad, then we would just use 2% times 100,000, $2,000 in expense. In this problem, they've already told us that the calculation was 5,000. So I'm going to debit uncollectible expense and credit my allowance. The beginning balance, I got another 5 here. So I end up with 10. And the question is, what is the net realizable value? Well, NRV equal receivables, debit balance minus the allowance account equals 40,000. That's pretty simple. And that's how easy this chapter can be for you. All right, let's take a look at this one. A little bit more going on here. Again, I would suggest that you pause the video and try to work this on your own, and then come back, restart it, and then let's see how you did compared to how I'm doing it. All right, here we go. Hopefully you're figuring this out. This is just, it's like accounting's like a little puzzle. You get to don't memorize all the formulas. There's people who fail my classes and they come in and they have in a notebook everything I've ever said and then a whole bunch of formulas. They're the people who are failing the class. You would think they would be doing good, but they're probably math majors. They're really good at math, but and they like stuff that's formulaic. That's just not going to work in accounting. You need to get to the logic. Once you get the logic, it's going to be like riding a bicycle. I got the logic. I understand this. And part of the logic is understanding the purpose and the business around it. But the bigger piece of the logic is just understanding debits and credits and how debits increase assets and credits reduce assets. Debits reduce liabilities and equity, and credits increase those. And understanding how that logic. And when you figure that out, it's going to be like a little puzzle. And you'll actually kind of enjoy it. There's a lot of students who get to enjoy this. I did in my first accounting class, and it worked out pretty well for me in my career. So, all right, accounts receivable has a $500,000 beginning balance, and I'm just going to use this in thousands. Notice how I love to use these T accounts. It makes it so much easier. There's a lot of words on this page, and they can be pretty intimidating. Even if I was in an exam, I would do a quick T account and put these dollars where they need to be. Then I can answer any question that I'm given. And so beginning of the year, balance for uncollectible was 15. There's that credit over there, 15. During the year, the company wrote off $10,000 of receivable. Well, we know that is a reduction in the receivable, credit the receivable, and a reduction in the uncollectible. So I've got that taken care of. What's my next number? Oh, the company collected $600,000 during the year. That means debit to cash, cash went up, credit to accounts receivable, it went down. And then, so I've got that one. And during the year, the company had $500,000 in credit sales, new sales. What was that? Debit accounts receivable for $500,000, credit revenues for $500,000. So I'll just put my 500 here. See, at the T account, really kind of quick and dirty. I don't have to write out all the journal entries. I'm just going straight to the T account here so I can answer their questions. And then the last thing we've got to do is, hey, calculate the uncollectible expense, because we need to debit uncollectible expense and credit the allowance for uncollectible. So you kind of back to those journal entries I taught you at the beginning of this video. Just know those journal entries and how what's the basis behind them, and you'll be golden for this subject. And so 5% of credit sales. And so what were credit sales? 500,000. So 5% of that, 5% times 500,000, 25. See, the math is easy here. It's the logic, knowing that that's a credit and that I have to debit the expense that goes to the income statement, reducing my profitability for the company, because there's $25,000 of that revenue during the year that we're not going to collect. Why do we know we're not going to collect? Because in years and years of history, we don't collect about 5% of those. And so it's the accounting now reflects the economic substance of the transaction. That's what's pretty cool about it. All right, now we're just back to chapter one or two, adding up my debits and credits. This is the easy part. So I got $1 million in debits minus $610,000 in credits. Oh, that's easy math. $390,000 is my ending balance for accounts receivable. How about my allowance account? I've got 40,000 in credits minus 10,000. I've got 30,000. So let's go answer the questions. What was uncollectible expense? Oh, 25,000. I've got that. What was a balance in the uncollectible accounts? 30. I got that. So when you see these multiple choice, I'm doing all three of these. Any of these three could be fair game. And then what was the NRV? I love to ask NRV questions, because now you have to know everything. You have to know how AR worked. You got to know the expense. You got to know the balance and the allowance. And so if you ask an NRV question on an exam, you got to know all of it. So that's kind of becomes good, fair game. And that's a $390,000 debit balance minus a $30,000 credit balance, 360. Easy, easy stuff. You guys can handle this. You guys are going to just knock this out. All right. Let's try this one. Again, pause the video, try to work this, and then come back and see. It's very similar to the last problem. So I'm thinking that you can knock this out. Try it out. All right, you're back. Hopefully you're getting this out. So I'm just going to do this from the T account perspective. But what's my beginning balance of my AR? It's down here. I'm going to check that off to make sure I cover everything. I don't want to miss something here and screw this up and then have to re-record this entire video. I do not want to do that. I got to get this right. All right. And then beginning balance for the allowance was 3,000. So you have to kind of know from this problem, what's the normal balance? And the normal balance for the allowance for uncollectible is a credit balance. All right. Revenues for the year, 400,000. Well, I know that's credit revenues for 400,000. A good guy on the income statement, a positive number on the income statement, and it's credit to revenues, debit to accounts receivable. So I'm going to come here, put my debit, in accounts receivable. Love it. All right. And then collections during the year on the account. So we receive cash. If you don't do anything else, think about the cash. That is increasing cash. That's a debit. Therefore, what do I credit? Accounts receivable. Another way to think of that is, you know, they owed us money, you know, and now they paid us. They don't owe us anymore. So I got to reduce the balance in the accounts receivable. How do I reduce an asset? Credit. See, it's all this logic. So it all fits nicely together. And then so I know I've got to cover the whole gamut of things of those first journal entries. Back to this page here, all these journal entries we started with. I'm gonna have all of these journal entries to account for. And yeah, here's accounts written off for 3,000. What do we do with accounts written off? We reduce the allowance and we reduce the receivable. So that's just a credit to the receivable and a debit to the allowance. We cannot expense it, right? Because we already expensed it in the prior year or whenever when we made an estimate. So this is way after the fact. And so the last entry, I've got to go calculate my uncollectible expense. I got to debit uncollectible expense, and I got to credit the allowance for uncollectible. So 2% times credit cells, 400,000. So 2% times 400. Well, I can get that 8. See how easy the math is here? You don't have to be a rocket scientist to do accounting. That's why I'm an accountant. I'm not smart enough to be a rocket scientist. So my ending, now we're done. I got 3 minus 3, 0 plus 8. So I end with the allowance account with an $8,000 balance. How about my receivable account? I've got 550 minus 500. That's now going to be 50 minus 3 more, 47,000. Let me look at my cheat sheet. I just don't want to mess this up. I make stupid mistakes like everybody else. And so there you go. NRV equals 47 minus 8 equals 39. So, and what was the uncollectible expense? 8,000. That's easy. 2% times 400,000. What was NRV? 47,000 in my ending receivable balance minus 8,000 in my uncollectible accounts. And we'll move to the last topic of this. I will tell you that one of my students once, I keep telling people how easy accounting is. Don't be intimidated by it. There's no reason to be intimidated by this. And he was struggling for a while, but then he started just really taking off. And he said, I asked him, how's it, man, you really have this really taken off? He said, you know what, Professor, I realize if you can do this, Professor, I know I can do it. So it was not a confidence builder for me, but it was okay, and I actually totally agree with him. If I can do this, I know you can do it. I'm not the smartest guy in the room for sure. All right, now here is a different look at the uncollectible expense. Now, some principles of accounting courses will not test you. This is called the aging method as compared to the percent of sales method. It's just another method of estimating the uncollectible expense. And so you might want to talk to your professor to see if this is going to be covered. We've started excluding this at the University of North Texas, where I'm teaching right now. But I didn't want to exclude it from the video because other students might be watching this, and I want to make sure I cover this. And so we're still doing the same journal. The journal entries do not change. What we're talking about here is another way of calculating uncollectible expense. And by the way, this aging, we call it the aging method. I love it. I think it's a much better method. I made, when I was the chief accounting officer of my 2 companies, my second company, they were using percent of sales method. I said, no, we're moving to the aging method. And they all said, oh, that's too hard. We can't do it. I said, I don't really care. You're moving to the aging method. So I think it's a better method. And I think you'll see that here. So in the aging method, we're going to calculate the ending balance. And then we're going to back into the expense, because we're going to go out, and I think this just makes total sense. Hopefully it will to you. We're going to just evaluate the accounts receivable. And so for this company here, they have $400,000 in receivable. And here's the 400,000 right here. Of that 400,000, 200,000 is 0 to 30 days. It's not, and usually we give them 30 days. This is probably not even past due. So most of this 200,000 is probably going to be pretty good. There's 100,000 that's 31 to 60 days. But look at this. Some of those accounts are not too good. Here's 70,000 of that 400,000. That's 61 to 90 days. A lot of that is going to be past due. And finally, we have 30,000. It's over 90 days. This stuff is probably not going to get paid, as well as the stuff that's current. And so, and this is where it gets hard for companies, is going and calculating that historical experience for each of these categories. But here, you don't have to do that because it's already given to you. And so you can see that, hey, only 0.5% of the $200,000 that's 0 to 30 days old we think is uncollectible. But 30% of those accounts that are over 90 days, since they bought the product, we know it over time. When a customer gets to being 90 plus days since we shipped them the product and they haven't paid us yet, that's a problem. And 30% of them ultimately will not pay. Now it's pretty good. 70% of that will still pay. We'll get collection agencies. We'll do whatever it takes. We'll call them every day and they get tired of us and they'll pay us. But there's 30% of that we're just not going to get. So in the aging method, we go and calculate these out. So if this 200,000, so instead of looking, we're coming at it from the balance sheet side, from the receivable side. Of this 200,000, only 0.5% will not be paid. So I'm going to do 0.5%, and that's equal to $1,000. And then this is times 1%. That's also 1,000. So 1,000 of this 100,000 will not get paid. 70,000 times 10% equals 7,000, and 30% of our 30,000 is not going to pay equals 9,000. So if I come and add all these up, I get to $18,000 of the aging of the receivables. Now, what's my NRV at this point? It's easy. 400 minus 18, 382,000. In other words, here's the balance of 400,000, but I've calculated now how much of this I will not pay by looking at the actual quality of my receivables. And so this number will be higher if there's more accounts that are past 90 days. So I do like this method. I think it makes more sense. And so here I'm going to come down, and I know my ending balance on the allowance for uncollectible accounts. What was my beginning balance? 10. No write-offs, so 0 here. And so I'm just going to have to come in and solve for X. 10 minus 0 plus X equals 18. All right, simple algebra. I don't even need to write it all out. I can see if I put an 8 there, 10 minus 0 plus 8 equals 18. Therefore, my uncollectible expense, and so I'm basically backing into this. 8, I'm going to debit that, and I'm going to credit my allowance for uncollectible account 8. So same journal entry, it's just a different method of calculating it out. So guys, that's it. This is pretty straightforward stuff. Again, there's only the 4 journal entries that we covered at the beginning of class. Let's see if I can find those still around here. I probably have already trashed them now. But again, you can do this. This is not that hard. And hopefully this video is going to help you get there. And thank you for listening.